Let's take it back to that top story. Some reprieve for indebted South Africans with the Reserve Bank's announcement that interest rates will be cut again by 25 basis points. Let's now speak to Momentum Chief Economist Sanisha Packirisamy to unpack what this means for consumers. Very good afternoon to you. And thank you very much, Sanisha, for talking to us. Your takeaways from what the statement that was made or delivered there by the Reserve Bank governor, but also just the bits and pieces some of us were able to pick up from from the questions that were posed to him by the journalists who were there.
Thank you so much for having me. I don't think there's a major surprise in the fact that interest rates came down by 25 basis points to 7%. If we look at the Reuters Econometer, which is a survey across analysts in South Africa, out of the 27 that were surveyed for July, about 17 of them suggested that there would be a rate cut that was in line with our own view here at Momentum. And 10 basically said interest rates remaining steady. I think what maybe did come as a bit of a surprise to the market is that instead of using the 3% scenario like they did at the May MPC meeting, they've now actually used that as a base case. So in terms of the question and answer session, I think there was a little bit of confusion around what is the actual target. We've heard from the governor that the target hasn't actually shifted. We are still operating within that 3 to 6% target band, but they are focusing more on the lower end of that target range and trying to guide inflation expectations down to the bottom end of that target band. As we know, it is ultimately up to the finance minister to make the call on implementing a new inflation targeting regime.
What was it a surprise, though? Because, I mean, the governor has been talking about the need for reforms for quite a while now, and especially over the last few conferences as we are building up to the G20 summit. And as he said towards the end this afternoon, there's nothing like a costless policy change. You have to look at the costs against the benefits.
100%, and that's what they usually refer to as the sacrifice ratio. And the sacrifice ratio generally tells you about how much your economic growth outcome dips on the back of trying to contain inflationary pressures. I think the element of surprise is not so much in that the SARB has been advocating for a lower inflation target for some time now. Earlier on in the year, they held an inflation targeting conference where there were many presentations and views put forward by other central banks as well, that all mostly came in favor of lowering the inflation target. But what we saw at the May MPC meeting was a central base case scenario using the 4.5% midpoint of the target with a side scenario of a 3% target in place. And this time around, they've actually just produced the 3% scenario as the baseline scenario. There are a couple of figures in the detailed publications from the SARB, just looking at what the inflation and GDP growth projections would be if they were still looking at a 4.5% midpoint of the target.
Because, I mean, worker unions, among others, are the ones who have been calling for lower interest rates, arguing that if you look at how indebted most workers and the poor are, because of the prices of food, prices of transport, there's a case to be made for even lower interest rates. But the Reserve Bank governor talking about, in fact, the costs of not going lower, a question, of course, that had to be fielded by someone else. Just your thoughts around that, what may be the thinking, because we lost that bit was when we came off the that briefing.
Look, what I think is really key here is the guidance for inflation expectations. Now, we get a survey from the Bureau for Economic Research every quarter where they survey households, analysts, businesses and trade unions in terms of their expectations for inflation. And we typically find that analysts tend to adjust their inflation expectations quicker than you'd see for businesses and trade unions. However, we know that businesses and trade unions are actually the price setters of the economy. And so I think quite a bit of this 3% scenario analysis that the Monetary Policy Committee has put together is contingent on those inflation expectations being bedded down at a lower rate. So coming from that 4.5% midpoint of the target down to 3%, which will then ultimately guide headline and core inflation in future years.
I mean, the expectations for higher growth, or assumptions perhaps, one should say assumptions also that the government, for example, will, in particular, will spend a lot of money on infrastructure. And how does all of that, of course, how will that have an impact on how the future or how the monetary policy of the Reserve Bank will see inflation going forward?
Well, if we look at the growth forecast, they have marked these slightly lower. For this year, they now see 0.9%. It's slightly lower than what the Reuters consensus is sitting at about 1%. And then going into next year, they also marked down the growth forecast by about 0.2 percentage points. So they're now looking for a growth outcome that's closer to 1.3% for next year. I think, some of this takes into account that we may be in a tougher trading environment, and so that could hurt our exports. And I think part of that has come through in terms of the growth numbers. In terms of the fiscal spending, I mean, our fiscal purse remains quite constrained. And so we don't believe that the biggest impulse to GDP growth is going to really come through from the government side. We also don't think this year it's really going to come through from fixed investment. We know that fixed investment intentions have been dampened on the rise of fiscal as well as political instability. We think that there can be a little bit of a recovery on household consumption expenditure, given that we have seen rates of inflation coming down. And so that means that there is more purchasing power in consumers' pockets, and that is likely to support growth a bit this year. Further out, I do think that, the element of structural reform, issues around the network industries improving in the energy space, logistics space, water. We know that there are now also efforts to overhaul local municipalities, bringing people closer to work opportunities, digitizing payments in certain sectors of the economy. And this is likely to provide a brighter medium-term growth outlook, even though the growth numbers for the near term still look quite soft.
My colleague, Dumisang Ndlovu, who is our business anchor on this program, we're talking about, she in fact was talking about how forthright and more forthcoming and a bit more frank the Reserve Bank governor was this time around. And I'm wondering whether we are seeing, or perhaps going to see, politicians on the fiscal side becoming just as forthright and perhaps a little more forward-looking and open than perhaps they have been until now. Because all along, the Reserve Bank governor seemed to be saying that they were being asked to do something that in part should be done on the fiscal side.
I think kudos to the South African Reserve Bank. I think their communication channels are excellent in getting information out to the public. We've seen that the public's knowledge of things like interest rates and inflation has increased drastically over the last couple of years. And I think that the Reserve Bank has played a huge role in that. I also think it might be premature for the National Treasury to put out a statement while the work is still being done on the inflation target, where it should settle, should there be a range around a lower target. And so, I think with that working group still putting things together, it might be a bit premature for them to release a statement from their side as yet.
That's where we're going to leave it for this afternoon. Let me thank you very much, Momentum Chief Economist, Sanisha Packirisamy.